A great startup always begins with a real problem that needs solving. No matter how advanced the technology or how innovative the product, if there isn't a clear problem solution fit, the company will struggle to gain traction. Investors aren't just evaluating features or technical capabilities, they're looking at whether the product truly addresses a pain point, whether it has long-term defensibility against competitors, and whether it can scale into a valuable, sustainable business. The first thing venture capitalists assess is whether the product is solving a meaningful problem. The best startups don't just create something interesting, they address an urgent, painful issue that customers are actively trying to solve. Strong indicators of a real problem solution fit include clear demand, with users already searching for solutions or resorting to inefficient workarounds, and a product that provides a measurable improvement over existing alternatives. If something is significantly faster, cheaper, easier, or more effective than what's currently available, it has the potential to take off. Early users who are highly engaged, converting at strong rates, and referring others naturally signal that the product is hitting a nerve. On the other hand, startups that struggle to find this fit usually suffer from one of a few common issues. Sometimes the problem just isn't big enough or important enough for people to pay for a solution. Other times, the product ends up being more of a nice-to-have than a true necessity. The most dangerous sign is lukewarm customer feedback when users are indifferent rather than excited. It's a signal that the product isn't solving a strong enough pain point. A great test of fit is whether users say, "I need this," rather than simply, "This is interesting." Venture investors don't just take a founder's word for it when evaluating fit. They look at customer behavior and early traction. High engagement and strong retention rates are critical indicators. If people try the product and stick with it, that's a sign it's solving a real need. Fast-growing adoption, especially organic growth through word of mouth, signals that people find enough value to share it with others. Passionate early adopters and strong customer evangelism are another key factor. If users are actively referring their friends and colleagues, that's a major indicator of demand. One of the best examples of this is Slack. Before raising major venture rounds, Slack had strong organic adoption within teams, a high percentage of daily active users, and strong retention, all clear signs that it was solving a real communication pain point. On the flip side, even some of the most technologically impressive products fail because they misjudge market demand. Google Glass, for instance, had cutting-edge technology but lacked a clear, widespread problem to solve. Without strong market pull, adoption was weak, and the product never took off. But even when a startup has validated problem-solution fit, investors have another critical question. What prevents competitors from copying this product? If a company builds something valuable, others will try to replicate it. Without strong defensibility, startups risk getting outcompeted, whether by larger, well-funded incumbents or by new entrants who move faster. There are 4 major ways a startup can build defensibility. The first is through proprietary technology or intellectual property. If a company has unique patents, complex algorithms, or deep technical expertise that others can't easily replicate, it creates a barrier to entry. This is why companies like DeepMind and Tesla maintain strong competitive advantages. Their AI research and battery technology require years of development and expertise that can't be easily duplicated. Another powerful form of defensibility is network effects. Some products become more valuable as more people use them, making it increasingly difficult for competitors to enter. Social networks, marketplaces, and platforms that rely on user-generated content often benefit from this. LinkedIn, for example, is valuable precisely because everyone in the professional world is already on it. Airbnb benefits in the same way. The more hosts and guests it has, the harder it is for a new competitor to gain traction. Brand and market positioning also play a critical role. A startup that establishes itself as the trusted leader in its category can build a strong moat. Stripe is a great example. It's not just a payment processor, it's the go-to platform for developers, thanks to its seamless integration and reputation for reliability. Even if another company built a similar product, Stripe's positioning in the market makes it incredibly difficult to displace. The final layer of defensibility comes from economies of scale and data advantages. Startups that accumulate large datasets over time, especially in fields like AI, develop a significant competitive edge. The more data an AI model has, the better it performs, making it hard for new entrants to catch up. Google Search, for instance, dominates because its vast dataset allows it to deliver better results than any competitor. Some companies also build defensibility through cost advantages, where scaling allows them to lower prices in a way that new competitors simply can't match. However, not all products are defensible. Investors quickly spot red flags that suggest a startup might struggle to maintain a competitive advantage. If there's no unique differentiation and the product can be easily copied, it risks being outcompeted. Low switching costs are another concern. If users can easily move to another solution without friction, customer retention becomes difficult. Dependence on a single major partner, such as relying on one API or distributor, can also introduce significant risk. And if a startup isn't iterating and improving its product quickly enough, competitors can surpass them in a matter of months. Ultimately, venture capitalists look for startups that have both problem-solution fit and defensibility. A company that solves a real problem but lacks defensibility might gain early traction, only to lose market share to competitors. On the other hand, a startup with strong defensibility but no clear demand will struggle to get off the ground. The best investments combine both: a product that fits a growing market need and a defensible advantage that makes it difficult for competitors to catch up. That's why VCs don't just evaluate what a startup is building today. They think about how the market, the product, and the competitive landscape will evolve over time. Because in venture capital, solving a problem is just the beginning. Winning the market and keeping that position is what turns startups into billion-dollar companies. Venture investors prioritize startups that solve urgent problems with strong user demand, but they also assess defensibility to ensure long-term market leadership. Proprietary technology, network effects, brand strength, and data advantages create barriers against competitors. While solving a real problem is essential for early traction, maintaining a competitive moat is what allows startups to scale and sustain venture-level returns. Winning in venture capital requires both, because solving a problem is just the start, but holding market position is what builds billion-dollar companies.